We're now set to go for our next panel discussion. This is on achieving and sustaining green finance, recent developments in green financing mechanisms, and climate change risk management. Our moderator for this discussion is Mr. Paolo Lombardo, Head of Regional Representation at the EIB. He'll be joined by Mr. Timothy Turner, Senior Advisor at Trade and Development Bank, Mr. David Ekabuma, Chief Executive Office Director of Monitoring and Evaluation at the Africa Guarantee Fund. And joining us virtually on the screen, we have Mr. Olympus Manthata, Head of Climate Finance from DBSA. Welcome, Olympus. Good to see you. And we have Mr. Peter Monroe, Head of Division at the European Investment Bank. Thank you so much for joining us. Gents, welcome to the platform. Those who are here in person, yes, you're most welcome. Please come through. Yeah, he's right here. It's on.
It's on?
Yeah, all the mics are on, so we're live and ready to go.
I stay in the middle.
Great. Thank you so much. Over to you.
Thank you, James. Hello, Olympus. Oh, no, you're there. No, I don't see you. Is there any way we can see Olympus and Peter on the screen? Ah, there they are. All right. All right. Good morning to all of you. Now, this session here, I think, is quite topical, and we'll try to be as concrete as we can, because the topic of green financing is highly debated, highly discussed, but then when you look at the numbers, something isn't just quite working. But anyway, I would like to thank the panel here today. We have basically veterans and I would say pioneers of green finance with us. To my right, Tim Turner, a long-term friend and colleague, now senior advisor to TDB president. Tim is the former CRO of African Development Bank, and prior to that he was director of private sector lending at AFDB. He spearheaded some of the most interesting, innovative financial instruments that I've came across, and I think you'll be interested to hear some of the things he's done. Moving on to Peter, a colleague from the EIB. He's another veteran in the field of green bonds for 15 years. So many of us started to hear about green bonds only in the last maybe 5 years. Well, 10 years before that, Peter was actually working on it. For the last 3 years, he was at ICMA, basically to develop green and sustainable bond principles. He's the author of books on the topic. Now, Olympus Manthata, he's head of climate and environmental finance at South Africa-based DBSA. Among other things, his team manages the Global Environmental Facility and the Green Climate Fund. For a number of years, he's been a fund manager in the green finance space. To my left, I'm pleased now to conclude the panel with David Ekabuma, Group Director of Monitoring and Evaluation of Africa Guarantee Fund. Prior to that, he was Chief Internal Controller and also Group Head of Business Development. David has led a number of advisory engagement globally with Deloitte and PwC. So enough with the introduction. Now, let me set the scene. I will not be long, but building sustainable and resilient economies needs two things. One is visionary and ambitious policies. The second one is money. You can have great ideas, but then you need the money, the instruments to actually implement them. I alluded earlier in my opening speech about how it is important that there is ambition, and there has to be ambition in both in policies and on the financing side. So without funding, best policies basically remain words. And I think we've seen a lot of that debate, the various COP, great ideas, then they just do not get much traction. Now, the world is moving on, so there is a need for more resilient, sustainable economies. I think we all have heard these words. Now, the reality when it comes to green financing, and I think we all, I give you a number that I got. You may have a different one, but out of the total green financing raised at global level, only 3% goes to Africa. Whether it's 3, 5, it doesn't matter. It's just very, very little. So in this panel, I think the objective is to explore why this is the case. This is the continent where a lot of the brunt of climate change is taking place. There are a lot of transformational projects ongoing that require financing, particularly in the digital and climate space. And we have to find out basically what is stopping things from taking off. But I think we will also hear that the glass is actually not half empty, it's actually half full. I personally have seen a lot of innovation, a lot of things that are moving, and hopefully colleagues in the panel here will tell us more about that. So with that, let me start with Olympus. Olympus, can you hear us?
I can hear you. Hope you can hear me.
Fantastic. So, look, there's a lot happening in the climate finance space in Africa, and Southern Africa is probably, has some of the most ambitious, at least in terms of numbers, programs in climate action. And that Southern Africa basically will face the challenge of how to finance that. So the question that I have for you is that ambition that you have, for example, in South Africa, but also in other countries in your region, matched by the right financing tools. Over to you.
Thank you very much for the opportunity. Thanks for the invitation. Yeah, I think, the need is quite big. I mean, if you just check, I think the latest numbers I've checked from UNEP, there was an estimate of a need of about 70 billion annually for developing countries. And I think the African Development Bank had mentioned that from an African continent point of view, you'd be looking at between 7 and 15 billion rands annually. So that need, I think, is quite pronounced and significant. And we know that, when you dissect that, you would find that from a mitigation point of view, the support would be, slightly better. But where adaptation is concerned, the need is big, but the flows to adaptation are quite less. I mean, the last number I checked was that less than 20% of, climate finance is actually going into adaptation, and only two-thirds of that into developing countries. So, and we know, I mean, typical challenges you would have for adaptation would be, just the type of risk return profiles that, might not maybe match what you require from a, private sector point of view, which is where you would expect significant financial flows. So, I think the need, yes, is in developing innovative financial instruments, but I think it's a little more than that. It requires also, from a policy point of view, that there is interventions that would allow those innovative financial instruments to work. This could range from, simply appropriate incentives or just fiscal resources being used to, in a way that allows significant flows. And I think there's a big part of that needs to be done. Another big part that I think needs to be looked at is, increasing support, especially from a project preparation point of view, because, I think, it makes sense to agitate for more financial flows to be made available. But then the question becomes, when they become available, can they be utilized? Is there, appropriate projects and ready projects to take them further? Therefore, I guess the need for, appropriate project preparation support and significant project preparation support to support implementation. And the other thing I just wanted to touch on is obviously resources coming out of the likes of your Green Climate Fund is quite a key in supporting and making sure that the appropriate concessional resources are there. But again, also when you look at that, it would require within various parts of the continent, including our region, Southern Africa, the capacity to do that. This starts from the ability of having institutions accredited to these facilities, which is a daunting task in itself. But even when you have that in place and you are successful in doing that, it doesn't guarantee the ability to move from there to being able to mobilize these resources, especially from an adaptation point of view. Mitigation might be maybe slightly better. Therefore, capacity development becomes key. And maybe just in conclusion, not to take too long, I've just been to a capacity building program in Abidjan for direct access entities of the GCF. And the idea there was really to use lessons learned among similar entities to learn from each other and hopefully start advancing and expediting ability to access these resources. And thanks to the Global Center on Adaptation, African Development Bank in putting that together, and hopefully that would help push things forward. Thank you.
Okay, thank you very much, Olympus. Thank you very much for your considerations. Now, Tim, I mentioned earlier that you've been pioneer in the financial product space. Now, we all hear about green loans, sustainable bonds, green bonds, but most recently, TDB has announced a new partnership with the African Development Bank, whereby the African Development Bank, will subscribe green shares issued by TDB. Now, to me, this is a very welcome form of innovation in the finance space. Why don't you tell us something about this interesting project of yours? Because I think you're the father of the baby.
Thank you, Paolo. First of all, let me thank the organizers, EIB and TDB, for a fantastic event, in particular Carmelo and James, who have been slaving away to make this all happen. We're very appreciative of a fantastic event. Let me just step back and say a common thread through a lot of my work over the last decade has been, how do we create pathways that allow commercial investors, the private sector, to support development? And traditionally, development has been financed off the public balance sheet. And increasingly, we find the constraint there is that the public balance sheet cannot keep up with the need. And this is now pretty much common knowledge. I think everyone's heard the slogan billions to trillions, which is nice. It's got a nice ring to it. But the question is now, how do you actually do this? And there have been relatively few big innovative ideas on how do we get that pathway that enables commercial money to support development alongside development institutions. Now, I think Peter your colleague is going to talk about the green bond market, which EIB is one of the creators of that, and it's now a multi-trillion-dollar market. So it's taken off. One thing when I joined the TDB, I was surprised that as we looked at the green bond market, there has not been something equivalent with a complementary instrument, meaning equity. And so at Trade and Development Bank, as you may be aware, a decade ago, we began to bring on commercial investors into the shareholding of the institution through what we called the Class B shares. Now I think they represent between 25 and 30% of total capital. So it's clear that there are, if you create the instruments, the pathways, there is interest from the commercial private sector to support development. The new innovation now stems from a study that we did in 2021 when we looked more broadly at the impact investing world that said, these investors say, we want to come to Africa, we want to do green. but we don't have a mechanism other than a few large stock exchanges, whether it be South Africa or Egypt. We don't have a way to express an investment strategy in green and in Africa. And so from that came the idea, well, why don't we create a new dedicated class of shares, which we're now calling the Class C shares, that would be complementary to our existing shareholding, that would be where the investors would put their money in as investment in Class C, and TDB would make a commitment to leverage that and do into financing green qualifying projects. Now, for a number of reasons, I think that the green equity instrument, to me, has advantages over green bonds. And the first one would be around leverage. Green bonds, as you know, we mobilize $1 worth of green bonds and we commit to $1 worth of investment into green assets. Whereas on the green equity, TDB will leverage each dollar of capital with $3 of debt to produce $4 of proceeds into green assets. So as an investor in Class C green shares, you get a 4-to-1 leverage ratio, impact ratio on your investment. And we found that that was extremely appealing to the investor group that we canvassed in 2021. The second advantage being permanency. On a green bond, as soon as the bond matures, whether 5 years, the institutional commitment to keep up green assets is gone. There's no formal commitment. Whereas in the green equity space, as long as TDB has Class C shares outstanding, it is committing to maintain a portfolio of at least 4x the value of that green shares, which means that it has to continually roll the capital back into new projects as the underlying pool of assets matures. So I see two big advantages there. Now, you mentioned, Paolo, that African Development Bank has once again pioneered with TDB as the first investor that has committed to the Class C1 investment. We are also delighted that they will tag along the Clean Technology Fund. I think many of you know the CTF has, we've applied for approval from the CTF board to participate also as an investor in the Class C shares. We are talking to several other of our most closest partners, EIB being one, IFU being another. We want to form a group of institutional investors that we know have the appetite to innovate with TDB, will have the capacity to help us evolve this instrument, make sure that it's done properly, and we can build out our internal infrastructure so that we can, have a smooth implementation. I would also like to add that our ambition for Class C shares actually goes beyond this, and we are now doing a sort of feasibility study on the idea of a Class C2, which would be a listed share. Because when we talk to impact investors around the world, they loved the sound of this Class C, but they need liquidity. They need an ability to get in and out. And having a listed share would provide that. Now, of course, there's a plethora of issues associated with that, and that's what we're investigating now, whether or not the benefits outweigh that. But if we could create a listed Class C share, essentially that, in my view, will open up a universe of investment opportunities that it's almost hard to imagine the potential scale of that. And that's where I think the innovation is going to come. And so I want to thank all the partners for their help thus far. We've got a lot of work to go, but the journey has started. The train has left the station. Using another analogy, we're pregnant now. It's time we're going to move forward. So we're really delighted. Thank you.
Thank you for that. And thank you for using the word ambition. And if we're not ambitious, we're not going to get too far. The road ahead is not going to be easy. So unless we're ambitious and we have the energy that you will see coming from other panel members, it's going to be not a great result. But I see, in particular in Africa, a level of energy that is amazing. So I'm very confident that the train will go far. Peter, now I think I've said many times how EIB has been a pioneer in climate finance. In fact, there is one dimension that people maybe now fail to grasp, which is that when we actually issued the very first ever green bond, basically there was no template for what constitutes a green type investment. No, now green taxonomies drive, the future climate financing, and there are a lot of questions around that. Now, can you please tell us where we stand on that front?
Sure, Paolo. Well, thank you very much for involving us from the, if you like, the Treasury side, where we've, as you say, been doing this for many years. I think it's interesting what Tim said just now about green shares. I mean, I think it's good that we have different alternatives in the capital structure. And one thing you mentioned is leverage. The other thing, of course, is that there are finite risk budgets in most developed country asset manager portfolios. And so one of the things they're looking for, I mean, before I get to taxonomy, just to pick up on Tim's point, is the thing investors are looking for is quite often some sort of credit enhancement. And so I think that's in a way the kind of protection you as TDB may provide as the kind of intermediary for the owners of your green shares. You're helping to get them to the projects. Other investors may want to get more direct exposure, but also have a bit of a cushion. And if you look at the recent paper from the Net Zero Asset Owners Alliance, they were very much advocating a blended finance model to enable their members to invest. But coming back to Paolo's question about taxonomy, yes, I mean, you've put your finger on what has been the thorny issue for many years, which is definitions and data. So what do we mean by definitions? What is green? That was really the question that was plaguing markets for many years, because there was no granular and science-based authoritative set of definitions. And many countries around the world, also in Africa, have been working on this. Europe was very much in the forefront of this, and EIB was one of the major contributors to the EU taxonomy, which is, I think, the first of its kind. And meanwhile, there have been similar ideas developed also in Africa, and I'll come back to that in a minute. There's an interesting paper out just in the last few weeks from both the Treasury of South Africa and the European Commission explaining and comparing these two taxonomies. Now, once you have the definitions from an authoritative source, you have a kind of benchmark, and you can either decide to make that more regulatory and mandatory or more voluntary. But even for the regulatory definitions in Europe, it doesn't force people to invest. It's more about regulating the types of disclosure. And disclosure is clearly the other side of the coin. If you have a definition, well, you need data disclosed against that definition. And adequate and comparable disclosure is what markets are looking for. And this offers them the kind of credible basis to make decisions. And that means, as we now see, that they can start to use the disclosures that are available to consider both financial risk and opportunity. And we start to see that impacting, for example, the judgments of central banks or credit rating agencies. And nonetheless, this is all taking quite a lot of time. I think there's still some frustration in markets that this isn't happening faster, but it is a learning and development process. In Europe, we're taking several years to phase in the taxonomy, and in a way that makes sense because it's quite a big process, even in large organizations, to digest and I would say produce the data. And then there's the question that we now face if we're thinking about the African perspective. What is relevant? Can we take global standards of taxonomy like the EU taxonomy, or should we be looking for a more local template? The answer is that, and if we take the example that's been developed in South Africa, there's a high degree of overlap, and both in terms of the screening criteria and in terms of the methodology. And that's a good thing. It enables capital to understand the respective frameworks and to flow across borders. I mean, nonetheless, usability remains a big challenge, and this is why taxonomy is causing a lot of how should I say, debate, and we at the EIB have been giving a lot of input to the EU platform on sustainable finance to try and help upgrade even those early criteria from the EU. This is going to be a process, not a step change. And we heard earlier about the importance of peer learning, and I think that's a very important point. We've also been working with UNEP-FI, and there they have one group looking at integration of taxonomy into banking products, and that's been a very useful way of doing things, so we can see in practical terms how different banks are progressing. And if we think about what the role of the private and public sector is, respectively, I think in both cases we need to lead by example. There are good examples of private sector and public sector taking the lead. And in our case, we've had to walk the talk, and in fact, have volunteered to walk the talk and put in place taxonomy disclosures against our sustainable bond issuance. So, for example, explaining how our finance projects contribute to climate mitigation. And of course, as Paolo will be able to explain to you, we are integrating taxonomy in the evaluation of our investments with clients. Now, the last point I'd like to make is about how investors are viewing this, because they have a healthy skepticism about the data they're seeing. And what's interesting is that investors are saying that, in fact, in Africa, among listed entities, the picture is quite a positive one. And I was looking at a recent comment from one of the large investors in Africa, a firm called 91. They have over 50 billion invested, and they were saying that the reporting tends to be of reasonably good quality among listed companies in Africa. And that, in my view, is a very positive message, because they also said that in many parts of the developed world, it was not necessarily much better. And I think this is because for all organizations, it is a challenging process to introduce, taxonomy-related disclosure. And I think that's why it was a very smart move for South Africa to also adapt the European schematic to its own needs, to link it to local legislation, to simplify in some areas to make it more usable. And so I would say that although taxonomy is a kind of super tanker that is moving forwards, we can still and should still steer the super tanker in the direction that we think is appropriate to help us understand, what's green and what's social and what's not. I'll stop there.
I like the analogy to the super tanker. So we're moving from a train to a tanker. So David, I don't know what you're going to come up with, but I look forward to that. David, AGF mandate is to facilitate access to finance for SMEs. Now, and you do this on a bulk basis. You're really scaling up that effort. Where are the main challenges you see that smaller firms are facing as they embark in climate-friendly investing?
Good afternoon, and thank you for the question. Before even answering to the question, I want to tell why SMEs are fundamental in the green transition. You mentioned that we need ideas, we need innovation, we need finance. That's correct. In sub-Saharan Africa, 90% of the formal businesses are MSMEs. So if we want to transition, green transition, we cannot achieve that without involvement of SMEs. Now, going back to your question, what are the challenges? There are many challenges, but for sake of time, I want to limit it to two main challenges that we are tracking constantly at AGF. It's affordability and accessibility. In terms of affordability, when small businesses embark on adopting climate investment, there's a problem because those technologies are generally more expensive than conventional technologies. You compare a solar backup generator to a diesel backup generator. You compare electric motorbike to IC motorbike. It's on the higher end. You compare solar cold storage with conventional solar cold electric cold storage. There's huge differences. Taking, for example, the smallest of the investment, solar fridge cost on the Pego model at minimum $1,200. Electric fridge would cost you, even in Kenya, 600, 800. So that high cost creates a lower return on investment and a longer payback, which in turn make it difficult for small businesses to embark in adopting those technologies. I'll give you an example. I once spoke to an entrepreneur who has 10 bikes. He told me, I understand that total cost of ownership with electric bikes, it's 20 to 25% lower than IC. But here in Kenya, one electric bike costs 160,000 Kenya shilling. You compare it to the same model, which costs 80,000 shilling. Do the math, it increases my payback period from 3 to 5 years, and it reduces my return on investment. Why would I do that? I know it's good for the planet. I know on the long term, it's good for my business, but that entry cost is too much. I cannot afford it. Then there's affordability. Only a small fraction of small businesses who would like to embark in adopting climate-friendly investment can access finance for two reasons. The first reason, there's just like all SMEs, there's a perceived risk that limits finance flow towards SMEs. Then there's a balance sheet issue on the side of the SMEs. They have weak balance sheet. Because of weak balance sheet, it triggers the need of additional collateral that often those small businesses lack. I've been involved in the industry since 2016 with the first generation solar home system. I made the introduction to one of the best, who is now maybe the best solar home company. I made the introduction to a bank. The company explained the model. They managed to convince them that the business model, although they were serving bottom of the pyramid, was viable, but yet they wouldn't lend money to this business because of the perceived risk. We were talking about a small company with 2 to 3 years of operation with a weak balance sheet. So the only way we were able to convince the bank to follow and to support that company was by providing a 75% guarantee at a discounted rate, providing capacity development providing capacity development to the entire bank to explain what is green finance, what are the challenges, how to mitigate them. So those two critical challenges are the ones that are slowing down adoption of climate-friendly technologies and investment by the small business.
Well, thank you, David. In fact, I'm glad that you actually did not try to go beyond tankers, but you went into the small, because at the end of the day, indeed, it is the SMEs and how they will move that will make a difference. And this takes me to what I heard earlier. I think it was Olympus. You know, you need also policies. Policymakers need to create the conditions for this transition, and the bigger entities have bigger shoulders. It is the smallest that, unless they're supported, they cannot go far. Look, I have a couple of more questions for the panel. James, if we go 5 minutes long, is that a problem? But I would like to ask panel members, please, to be very, very brief this time, because we will allow for some time at the end for questions. Look, Olympus, there is one topic that I really want to cover here, which is, it was picked upon by Tim. The demand needs, the investment needs are huge, and there are issues on the public sector side, limited fiscal space, but we have a lot of public sector entities that are supporting the transition. At the same time, you have the private sector. I mean, how do you see the two working together in harmony, and having the output of the two working together being the sum of the two parts? So the question is really about, you are, a public sector entity, also David's, AGF, you name TDB, but the big bucks are out there, are not in our space. So how do we work together and create that pathway that we both need to basically, undertake? Over to you, Olympus, but briefly, please.
Thanks for the question. I think for me, the key thing is, especially for, National Development Bank like ourselves, where we have access to concessional resources, the key thing is how best we use the limited, concessional resources to leverage significant resources from the private sector. Just as a quick example, I mean, we set out to do exactly that in South Africa with commercial banks, where we set up a facility. We called it a climate finance facility. And the idea was really to look within the pipeline of projects existing within commercial banks and to see how we could unlock that. And what we did in consultation with the commercial banks, we found out that there were basically, a few key barriers that, if unlocked, we could see significant flow of those funds into mitigation and adaptation projects. And the way that we did it was really to set up a facility where we can provide, credit enhancement interventions. The first one was simply in the form of subordinated debt to help de-risk project. But what was more attractive to commercial banks, we found, was a tenor extension facility, where for those who would be limited maybe by, for example, your Basel III regulations in terms of how long they could finance, our ability to come in and extend the tenure through this facility was found to be quite a key for the commercial banks to unlock flows into mitigation and adaptation projects. We are currently implementing that, and we think it's working quite well. Thanks, Paolo.
Thank you. Tim, quickly, both of us are former risk managers. Now, if you look at the banking sector across Africa, in fact, if I look at the NPL ratios of banks that we lend to, I have to say that I'm quite impressed by the resilience after the shock of COVID, now the shock of the Ukraine war. But there is this risk looming around climate risk. How prepared are the banks to be hit by this train?
Well, thanks, Paolo. as a former CRO, this is obviously one of the areas that we were, focusing on, and I think it's becoming a much more central focus for the risk folks. When you think of the climate risk, sort of the kind of the two main buckets, the physical risks. Today, many of the projects that we have done face physical risks that those assets could actually be impaired because of climate change, and I think increasingly what's happening now is that those physical risks are being part of the due diligence process in the new projects. But that obviously doesn't change the stock of projects that are out there already and assets that can be affected and will be affected by negatively through climate change. And then there's the what they call the transition risk, which is, we've invested in assets that may no longer be the flavor of the day, that will actually be considered to be assets that are stranded. And of course, that creates a new risk as well, particularly in the energy sector where if you've invested in coal-fired power plants and that is no longer is a thing of the past. Now, today, that's not the case, but we can see that end of the tunnel on that. Those are clearly risks, and I'm encouraged because I think there has been much more thinking in the past few years. I believe Kenya in particular is a leader in this area, thinking about what are the issues that now need to be on the table from a regulatory perspective, ensuring that the standards are applied by all of the commercial banks. Speaking for the Trade and Development Bank, I know it's on the agenda now. We're developing our first comprehensive climate strategy, and that will include also how to integrate a more explicit focus on climate risks into our own internal credit process. If I may, I just take 1 second and add to what you were talking about with Olympus. I've been personally involved in a number of transactions with the idea of creating new pathways to enable private capital to support development. And I've been incredibly encouraged by this. I think that we have basically only now scratched the surface of the potential. We need to have new instruments and new pathways. There is funding out there that wants to do good, wants to get remunerated for it. We just have to create the vehicles that enable that to happen. I'm on the investment committee of a fund that's managing Dutch pension money. We are now co-investing, co-financing with MDBs, multilateral development banks, with direct risk, clean risk. And many people said this was outside the appetite of the commercial world. We know that it's not outside the appetite. If it's properly structured, there is appetite, and I don't want to say the funding potential is limitless, but it is huge. So, this to me is very encouraging. There's much more to be done.
Thank you. Thank you very much for this observation. So I'll shock you here. Actually, there is a lot more money out there than we can even imagine. It is indeed a way to bring it, channel it in the right direction. There is a lot of money. Money is never the issue. It's how to get it to the right place. Peter, again, I'm going to ask you actually a very difficult question for which I will only give you 30 seconds. So yesterday, somebody walked into my office and wanted to talk about peace bonds, which basically now triggered my question to you. So last 15 years, you worked on green bonds. 15 years from now, where do you see policymakers landing? What are the macro trends you see? Obviously, more than 30 seconds.
Yeah, this is a big question. Well, thanks for the question, Paolo. I think that just frames the level of ambition we need to have. I think to take the tagline of our sister company, the European Investment Fund, which specializes in equity, you have to believe in small. So you have to be able to, I think policymakers who are successful will have understood how to deal with the riskier slice of the capital structure from early stage onwards, but they will also believe in big. What do I mean by that? Blended finance vehicles at the moment are simply too small to pick up that institutional capital. The average size is around 75 million. The minimum size that investors are asking for is $500 to $750 million. And that is why we at EIB are also studying vehicles in that larger spectrum, funds where investors can come in with sufficient ticket size to make it move the needle in their asset book. So I think in 15 years, we'll be looking hopefully at a situation where there are more larger blended finance vehicles. There's more action also in the early stage capital. And I also think we'll see that green and sustainable will be a mainstream part of business. And I think those that equip themselves now with the more manageable use of proceeds debt products governed by ICMA or LME principles in terms of loans or bonds will be well equipped. And those testing the KPI linkers may prove to be visionaries because that helps you align with your decarbonization or maybe biodiversity targets. And we've talked about risk integration. That is clearly that train is also moving, and central banks are on it, and rightly so. And if we think about one of the next big stories that will maybe in 15 years look like a common consideration, but is still proving challenging today, that is natural capital and biodiversity. That is the next big frontier. Roughly half of global GDP relies on natural capital and ecosystem services. Again, that's another area where we're only scratching the surface, but I'm sure along with climate and perhaps also circular economy, we'll see those as very mainstream areas of finance. And the sooner we get familiar with them, the better. So I'll stop there. Thank you.
Thank you very much. So the train is moving, the ship is sailing further away. Look, David, again, one last question to you on the role of and importance and the future for public players like yours, because I see a lot of innovation, to be honest, coming from the public sector. I was in Abidjan a few weeks ago at the FIX, I don't know what you call it, a conference with all the basically public sector development banks. And if I look back 10 years, you would have thought, those would never be the ones actually driving the innovation in finance. And I think AGF has done some very interesting innovation. So again, same question, 15 years from now, will the likes of us in the public space still be there? And will we be stronger, bigger? Or at some point we will fade away and you see us leaving the floor to the private sector?
Fading away and leaving the floor to private sector, we tend to say that we are working to take the need of guarantee out of the market. That's what drives us. So in terms of public sector role, I see it at two levels. On the supply side, and on the demand side. On the supply side, it's about fostering innovation by providing risk capital to private sector solution, innovation, business models that are reducing the high cost of a climate-friendly investment. It's exactly what happened with solar panels. It's taking place with batteries. So it has to go, and because it's innovation, public sector can take that catalytic role and support them. On the demand side, it's continuing fostering the mobilization of private resource by providing, we still have financial institutions still have a challenge that they are facing in terms of tenor mismatch. They have short-term deposit, and we are pushing all of us towards financing medium to long-term investment. How do we do that? We do that by providing medium to long-term financial results, obviously at concessional terms, to able to tackle that issue of tenor mismatch. We keep pushing innovation. We keep supporting innovation and innovation in risk mitigation instrument. Conventional wisdom has been to be sustainable. A guarantee fund should provide only pari passu guarantee. Okay. Public sector can also support vehicles that are offering first loss guarantee to mitigate that risk that financial institutions are taking.
Very well. I don't know. I think I'm told we need to close. So, James, I want to thank the panel members, all of them, also the one who attended virtually. James, I don't think we have time for questions, but I really want to thank the quality of the intervention so far. Thank you so much.